Okay, we are live, and I'm going to start.
This meeting is being recorded.
Awesome. Thank you so much. So it is a pleasure to be here today. I am Dana Zanders. I am one of the counselors here at the Wise Women's Business Center. For those of you who are new to Wise or maybe unfamiliar with Wise, Wise actually supports and empowers women entrepreneurs through all stages of their journeys by providing one-on-one counseling, training, providing resources and networking opportunities, just in whatever capacity women entrepreneurs need the Wise. We're here in the community to assist. And I am very excited about our conversation today. We're going to be talking about financial fundamentals. And for those who are new to the Power Hour, it is designed to be extremely interactive. So there will be an opportunity to ask questions. So if you do have a question, feel free to unmute yourself or either put your questions in the chat. But I'm looking forward to our conversation today and our expert guests that we have here from Equitable. So with that said, I'm going to pass it over to our guests so that they can introduce themselves. We have Sabrina Cabrera from Equitable, and we have Colin Wilcox.
Yes, hello. How is everyone doing today? Are they able to chat and join in at this time too?
Yeah.
Okay, awesome. All right, so Colin, I'm actually gonna have you just begin. I'm unfortunately not able to see your screen again.
Oh, no problem. So really, I want to take a chance just to thank everybody for showing up today and listen to what we have to say. And then it seems like a topic that, people are excited to cover. So, really, we'd just like to start off with just going through some real basic fundamentals, talking about building a budget. Today, we're going to cover, talking about credit scores, the importance of exactly what that might have to you as a business owner and how you can make sure you might be able to improve that, some simple tips. And then ultimately at the end, covering different types of life insurance policies and specifically how those go into collateralizing for the sake of a business loan, maybe also even talking about how they can be utilized to further your business succession planning. There's a lot to talk about there, but we can always start right off at the beginning, just with simple budgeting. So, and feel free to, by the way, as we have any questions, you can toss them in the chat. Any comments, feel free to also toss them in the chat. I'll try to pay attention as much as possible. And Dana, if you see anything that pops up, feel free to interrupt me. Always love being interrupted. So just to start off, how many people have really done any work building a budget or maybe have even struggled building a budget, especially in modern times when kind of life's been tossed on their heads? It's always something that's difficult to kind of quantify because people always think it's something that has to be followed strictly each and every month. And I always like to think it's kind of like Weight Watchers, where if I'm ever trying to lose weight, it's a lot easier for me to kind of track exactly what I'm doing. And I know my points are never going to be precise, even though my perfectionist self always wants them to be. But I know at least I'm making progress in the right direction. And, that's kind of why you want to make sure when you're making a budget, you cover in general terms. You can always break down and do specific dollar amounts, but general terms, what you want that budget to cover. And we kind of call that what is like a 50-30-20 rule. So that's going to be, you want 50% of, the kind of your cash flow coming in. You want that to cover your needs, things like, your housing costs, your food costs, things along those lines that you absolutely need to pay each and every month, electric and trash, depending on where you are. And then 30% on wants. Things that you do want, and it's very important to give yourself a sense of incentive. Whatever, no matter what business you're in, and especially if you're an entrepreneur, you need to celebrate the little things, and that's why that 30% on wants is important. things like clothing, entertainment, even just wanting to have the freedom to go out to dinner on a Friday or Saturday. That's always a huge thing to keep yourself going back and continuing to put in the hours necessary to get the money to do that. And then 20% is going to be on savings and investment. And that for business owners is a little bit different than it comes to individuals, because if you're a business owner, you're very familiar that a lot of the money that comes in goes back to reinvesting in yourself and your business. And that by all means is an investment. When we talk about building a budget, especially for business owners, I mean, you can build an individual budget, you can build a personal budget, but those two areas are inextricably connected. And it's important to, understand that. When we save for retirement and when Sabrina and I build a plan, we always want to talk about, things like an IRA, which we would call a tax qualified account, or things that you might save in a brokerage as a tax non-qualified account. Same thing, a tax non-qualified account, just like your checking and savings. That's a place where you can access money for the most part, more liquid. It's some place that's easier to access. We count your business as a tax non-qualified account. It's an investment. A lot of people, it's the primary drive of income. It's also going to be a thing that a lot of people might even sell as they get towards retirement. So it really is an investment, and it's something that you should focus on for sure. Now, to walk through just a couple of those things, is there anything else you wanted to add in there, Sabrina?
No, I think it's always wise when you're setting your, I'm sorry?
Oh, no, sorry.
Okay. I think it's always wise to take a look at a spending plan, like where your assets are already spoken for. And that's something that, does anybody else hear that or no? Is someone saying something?
That might be
Okay.
me. Let me mute myself while you're talking.
Oh, okay. So I think it's always wise to kind of know where your money's already spoken for, so you're not spreading yourself out thin, and making financial decisions on more of an educated understanding of what you do have to leverage and what you don't, like counting your dollars twice for a specific project. So that's something that we do like to make sure that we're encompassing a budget, not only on what we spend, but what we already have expenses for.
And then I just have a quick question. When you talk about those percentages and the spending plan and the budget, how often would you recommend reviewing your spending plan and your budget if you're not spending within those parameters that you guys just talked about?
I always find it wise to at least have it reviewed annually, at least. But also I will put in this caveat that if there's something that changes within your business seasonally, it's always important to review during those sorts of checkpoints. So I call them checkpoints. It's just a way for you, if you're a person that has a business that's mostly seasonal in the summertime, you should probably have a semi-annual review during the beginning of that season starting and the end of that season ending. So at least annually, but also be mindful of your seasons.
Okay.
And, when it comes to also kind of making sure it is a living document at the end of the day as well. You don't always have to heavily go through and audit exactly, and it's per individual. Some people want to aim for that percentage. Some people want to do specific dollar for dollar, but things change month to month. And just like if it were a workout plan or a dieting plan or anything else, it's something that you kind of police on yourself as you move throughout time. So I think it's also important. It's really easy to do it once and then not look at it again for a couple months and being like, I got to get back on, the horse here. I got to make sure I'm following what I put in place for myself. But making sure that the more that you look at it, the less stressful it becomes. And coming down to breaking those three different groups down a little bit more, right, is when it comes to needs, that's something that I feel like a lot of people do overlook at a certain point. I mean, just because it's something that is each and every month that you do pay for doesn't make it any less important, because you also have to think about what happens in the case of emergency. Those needs, you want to make sure that while you're saving for those needs as well, that it's for about 3 to 6 months of your expenses. And depending on who you are and what your needs are, it might be on the kind of the 6 months or longer than that you might want to plan out. But also if you're just starting out, going a little bit closer to that 3 months or 2 months, it really just is a comfortability thing. And then you want to focus on some other percentages. 25 to 35% of your needs category really is going to housing, and especially in a place where rent is really high nowadays, and especially it's also a seller's market if you're buying a house. It's not too far-fetched to see that that's where a lot of your money is going to end up going. But then 5-10% food, and 7 to 10% for your car, 7 to 10% for medical as well, down to your work-related expenses, which can always inflate a lot more depending, again, what your business is and how heavy that cash flow might be needed. But another thing to also, which we'll definitely cover in a little bit, is also to focus on debt repayment as well. That is a need. Your credit score is pretty dependent and heavily dependent on, how frequently and how consistently you're paying down that debt. So whatever debt that might be, and especially keeping track now that student loans are still in deferment, that you are making those payments as regularly as possible. If you have anything else you wanted to add there, Sabrina?
No, the only thing is that I know that Colin and I love talking about numbers, and we can share them all day. But sometimes I notice my clients' eyes glaze over a little bit when we say 50, 30, 20, and it just flows. So I just wanted to check in with everybody, see if they had any questions on some of the things that we said, and if we needed to add clarity to anything. No questions? Okay. Perfect. That was
brilliant. So, really coming down to building that budget, and I'll keep that really brief, is just to, a couple of tips is to start with goals. Whatever your goals might be, I think a lot of times people put travel, and I know that's hard now, but I think that is also something to plan for in the future. The pandemic and how it's panning out now, and I'll knock on wood, the numbers as of late are slowing down. And if not, I'm sure we'll have another pickup and whatnot coming in the future. But, it does give you kind of a portal back to the world where, COVID wasn't a concern, and where you could take trips and whatnot. So, whether it be travel, whether it be something you're paying off, whether it be something that you want, starting with those goals are important. And then 2 is knowing your actual income and being honest with yourself. Especially in the case of entrepreneurs, we see all the time people might inflate their income, and people might also deflate their income. They might have extra dollars left over that they don't always know what to do with. But understanding that every single dollar you can make a plan for, knowing what that number is and making sure that you do the work consistently to get that income is important to do as well. And then also be honest with yourself on how much money that you're actually spending each and every month. That's another place. It's again, the Weight Watchers syndrome. You always want to say, I won't log this one. I won't think about that. And a big place we always talk with clients about is evaporative spending. Evaporative spending is what is kind of a whole blanket statement for, hey, I'm going to go get, a coffee. Do you want to come with me? I want to have lunch today. Let's go out and just grab a sandwich. Things like that, you just never really think about you're spending money. It's just kind of living life. But that's probably one of the biggest places when people come up short or have windfalls or shortfalls, where, that's the biggest cause is just not knowing exactly what your evaporative spending is. So for that, we always say set an evaporative spending limit, or at least a goal. Maybe it might be $500 a month. Maybe it might be $200 a month, but understanding what that is important. And lastly is just being realistic with everything, and to make sure that you revisit your goals, just like Dana said, and Sabrina as well. With that kind of being on the whole budget aspect, to move over to, credit and managing credit card debt, improving credit scores. Anybody have any questions on the budget? We can always send you a template or two that we have for clients as well. If anybody ever wants to do that, feel free to contact Dana or ourselves. We're more than happy to share that with you. All right. Excellent. Well, we'll connect with you right after we're done here. We'll make sure we'll get that over to you. All right. So moving on to credit cards. This is always a big conversation that people want to have, and it is important. It's going to really come down to understanding kind of the mystery of credit scores, and where generally speaking, entrepreneurs and people just in general, like where that credit score kind of plays a role in your overall business. So I think to start off, I would always like to start off with bad habits, as we would say. And those habits would be, really just using a card as your main form, meeting ends meet. And of course, sometimes you can't avoid that. But as a primary goal, you want to make sure it's something that you use as a tool. Credit is not inherently bad. It's also not inherently good. It's just a numerical set of scores. But at the end of the day, it's just like a hammer, a screwdriver, a drill. It's just a tool. Now, how we can leverage that tool is also knowing kind of some of the background in terms of what how your credit score is looked at. Now, generally speaking, you don't want to own more than 5 cards at any given time. And that comes down to, if you do have too high of a credit limit, you actually are seen as a liability by creditors. And that is something we want to avoid, because it can really affect your credit score. You're also wanting to make sure that you research all the options that are available for funding. Sometimes in the case of entrepreneurs specifically, there's a lot of funding that's out there, and WISE does a great job about helping you guys find exactly what those funding opportunities might be. But using, again, your credit card as your first kind of form of defense is not something we want to be doing. Classic one is just not exceeding 25% of your overall credit line. The lower, pretty much below that 25%, you'll see that whatever credit reporting service you might use, you'll notice that that 25% is always listed. That's a big one. It really does we'll go through specifically the percentages and how those affect to your credit scores in just a minute here. But staying below that 25% limit, almost every single app will let you know what percent of your credit you're using. So, and we just had a question: is this business credit or personal credit? I didn't see the end of the question there. If you can see that, Sabrina, but this is actually a little bit of both. So talking about personal credit and business credit in general, they're separate. That being said, it's a gray area, because most times, especially if you're a new entrepreneur, depending how far you are along, they're going to always look at your personal credit history, unless you have an existing well-established business with its own credit line, and that does take time to build up and to get to. I don't know if there's anything else you wanted to add on that.
No, that's correct. I also want to encourage people, if you haven't taken a look at your credit report. I don't know if you guys actually even know that, but annualcreditreport.com normally only allows you to pull your credit score from all 3 of the bureaus once a year, but with everything going on with COVID, they've extended that to allow for you to pull your credit for free on a weekly basis through April 20th of this year. So just something that's very important to know is knowing what's on your credit report and things that you be mindful of, while you are also intentionally trying to build that credit score up as well.
Can you talk
so the other part of the question was, where does it matter?
Go ahead, Sabrina.
Oh, I was just saying the other part of the question was, or does it matter? So you did read pretty much the portion of the question there, Colin. I'm sorry, someone had a question though?
That was me. I just wanted to, if you could just elaborate a little bit on why having the personal credit matters and how it impacts your business credit. You could just elaborate on that a little bit.
Sure. So
Sure.
the
Go ahead. Okay. So yeah, really, it's going to come down to depending. A lot of these questions are going to be depending where you are in the cycle. So think of it, if you're going, and a lot of people, I'd say that you might find at least this talk beneficial might be more in the beginning stages. And let's say you want to go out there and you want to start a business, and to start any sort of business, and some more than others, you're going to need funding from different areas. And to get funding, to have loans, to do whatever it is that you'd like to have, to get to that point, you need to already build a decent credit score, or at least, be moving in that direction. So, when we talk about pretty much credit across the board differs between different areas. I mean, there people still have business credit cards. Even ourselves, Sabrina and I will reinvest into our own practice, making sure that, if we do make a larger, purchase for our own business, that we know we can pay it off. Or even, I know for myself, it can come down to, it's really the same rule. But when you're opening up and starting a business and trying to actually get loans and whatnot, there is an inherent connection between the two, just in the way that the bank will view you for getting loans. Now, as you move throughout the business cycle, you become more established, and you have, you can show a solid, income coming from your business. Then you reach the point where your business can be a little bit more autonomous. Maybe you have employees working for you, or a single employee. Maybe you have a lot of contracts built up, or depending on what it is that you have, you can ultimately show revenue and business progress. Where your business becomes a little bit more autonomous and it's not so based off of yourself is where your own business credit can become a little bit more independent. But I think a big thing I would always just make sure that people understand is that they are inextricably connected at the beginning. And there really is just kind of a gray blur area between the points of where does it matter? In my personal credit's not so great, but my business credit's great. My business credit's not so great, but my personal's great. Personal credit is the building block for your business, certainly. Hope that answers your question, Dana.
It does. Perfect. Thank you.
And last two hit home for me, because we all like our free miles, but using rewards programs as an excuse to buy things is always something that we'll see people do, depending on where they like to go. And that cash back, whatever it is that you're actually utilizing that for, keep in mind it's always an incentive, kind of like a casino in a way. The house always wins. Whether it's frequent flyer miles, whatever it might be, all of those points are given to you from the companies that issue the cards. And it ultimately behooves them the most, otherwise they wouldn't offer that as an incentive. So, while it is something that people, and I've seen my own mother, do a great job about getting free miles, free points, free cash back very efficiently. But, it is something that you want to keep track of, that it doesn't become more important than the credit itself. Do you want to cover good habits there, Sabrina? Oh, you're muted.
Sorry. I'm going to have you keep going, Colin.
Oh, no problem. So good habits, paying your bills on time to avoid late charges is a big one. Anytime that we're talking about credit in general, the biggest thing you can do is pay on time or ahead of time and above the minimums. So, two is to review statements that you are actually getting from your credit company as fast as possible. each and every month, because you never know. Especially there's a lot of times, it even happened in my own family, where somebody will leave your credit card to get stolen, or obviously you want to make sure you cancel your credit card, or make sure you're monitoring that. Sometimes there'll just be illicit charges. It does happen. So you want to make sure you're maintaining that, because you don't want somebody else accessing your account being the reason that your credit score is not where you'd like it to be. To pay off the full balance every month if possible. Obviously, if it's, you also can play with that rule a little bit, stay below that 25% barrier. If it's below there, you can make regular payments, but the larger purchases that do exceed that amount, you want to make sure that if you're putting it on your card, maybe to get points to improve your credit, because putting a larger purchase on your card but then paying it off quickly does look great as somebody who might be lending to you or giving you credit. You just want to make sure that you have a plan for paying that off and you're not shooting from the hip. And if you're tempted to overpay, there's no harm in lowering your credit limit. People might be happy to have a credit limit that's a little bit higher, just because it allows them the flexibility to maybe make larger purchases for themselves or their businesses. But also be realistic with yourself, and that really is a big thing to make sure that we're talking about. In terms of, are you tempted to overspend if you have a higher limit? Just make sure you lower that limit to more in the bounds of where you feel like you should be. And take steps to really protect yourself against credit card fraud. Don't give away personal information to people over the phone that might call you, and you even know how scary the conversation might be. Always want to double check. There's always, I know even my dad a couple years ago, he got called from some guy who said he was from Apple, and it seemed very legit. And only up until the point where they asked him to give his personal information away was he kind of red flagged. They said his account was being hacked, and that he would, they had access to his credit card information and already, and so there's all these different things that come through. Be very aware that it's something that still happens a lot today, and people think that credit card fraud might be a thing of the past, but it is something that you want to be cognizant of. Let's see here. Doesn't a higher I've Eileen Collins saying, doesn't a higher limit help with the ratio if your balance is low? The ratio is your balance if the balance is low. So yes, again, and it's ultimately at a certain point, having a high credit limit is beneficial. There is a point where if you have too many lines of credit that make up a credit limit overall, or if you do have a large, like let's say you're an individual and maybe not so much a business, that where if you do have a higher limit, it's beneficial. But I guess I'm more talking from the side of things where if you're somebody on your own personal credit side that is tempted, if you have a little bit of a higher limit, it is a building block. You don't want to jump ahead too early. If that's something you struggle with, be honest with yourself and just lower the limit. But by all means, at a certain point, you do want to have a higher credit limit, understanding that your ratio is important to stay below that 25% utilization. Hopefully that helps answer that question, Eileen. Excellent. Now, real quick, people always talk about, and this goes for across the board, ways to pay off your credit. And whether it be student loans, whether it be a mortgage or credit cards, because you might get caught in the vicious interest rate loop that seems endless. What do you pay down first, and how do you go about doing so? And we always say, there's two different ways that you can kind of attack your overall credit. And there's a snowball, and then there's an avalanche method. You can think of it as a snowball. Is the idea is that you start the snowball rolling from the top of the hill, get to the bottom, and suddenly it's a gigantic snowball. That's really where you want to attack your small balances first, then your medium and your large. The avalanche flips that up on its head, where you attack the high interest rate first, then medium, then low. Generally speaking, if you have the opportunity, the the place where you have the most interest rate, and this is just, on a personal level too, that's where you really want to make sure that you're attacking first. And whether it be you're using a strategy of just paying extra down on your principal, or if you're, saving some money in the stock market and putting money away. So let's say your interest rate's 5%, but you can get 8% in the stock market, then that extra 3% can help you pay off your debt all that faster. And then you could pull it all out at a later date and just pay off your principal in one foul swoop. But starting with those high interest rates first is important. And what we often find, those medium and large balances that you have on debt, those really are going to be your home, your student loans, things of that nature that you can't really attack so easy. That's why I personally really like the snowball method, going with those smaller debts first. If you have a lot of lines of credit, whether that be business or personal, generally speaking, you find, especially as you grow your overall credit score, that, in the beginning, those interest rates can be killer. They can be high. The quicker that you pay off those smaller debts, if you are kind of in a pinch and you want to lower the overall amount of debt you have outstanding, those generally you'll see have higher interest rates. You can also utilize other modes of debt consolidation. Think if you're somebody who, as an addition to your business, might be a real estate investor, or even you might have a house and be a homeowner already. Don't always write off just having the equity in your house as an opportunity to do a cash out refinance. Oftentimes you might be able to find an opportunity to lower the overall amount of debt you have, especially if you have a bunch of credit cards. We would always more than happy to make that connection. I'm sure Wise has those connections as well. And just finding somebody who is like a mortgage lender, that's always an additional great thing to talk about. So we have another question from Eileen Collins. Is it advantageous to consolidate or balance transfer to take advantage of the lower interest rate for a certain period? That will depend. Whether it ends up being, it depends on your cash flow. It depends on the situation. I would say a long-term play, and a solid long-term play, is doing some sort of like a consolidation, because that's going to be assuming I have all of these high interest cards, or I have this going on here. I want to pay this off. I just don't know where to start. And maybe you have like a 22% card, 13% card. And it's a lot to handle. A long-term play, if you have steady income, would be to do that consolidation, refinance, whatever it is that you choose to do that. If you do have, for a shorter period, an opportunity to do a balance transfer, it's kind of like a Band-Aid solution. Because if you have a shorter period where you have zero interest rate or lower interest rate, if you have the funds to pay that money off, absolutely. But if we're talking about a longer term thing, I would definitely say consolidate. So an answer to that question, Eileen, would definitely be conditional, depending on where you are. And we, in either ourselves or other individuals that are debt consolidation experts, can always be referred to you. You can sit down. There's a lot of people that specialize, especially in student loans right about now, the best way to go about paying those down, whether you work for a nonprofit, otherwise. I didn't know if you had a question there, Dana. Yep.
I think I do. So I think Sabrina talked a little bit about accessing the credit report, talked about ways to improve credit, also talked about consolidating debt. Now, what about if you have negative, let's say you didn't do any of that, now you've got negative information and you've gone out and you looked at your credit report. How long does that negative information stay on your report? And then what would be the best way in your recommendation in terms of tackling getting it off of the credit report?
Do you want to take that, Sabrina, or do you want me to take that?
On the slide.
Yeah.
So it all depends on what specific item, but generally speaking, there's a 7-year rule, a 10-year rule in regards to the negative impact. Can you guys hear me okay? Because you guys are cutting in and out on my end. Okay.
You went away, Sabrina.
I'm sorry?
Oh yeah, yeah. I don't know if you cut off there, Sabrina. Depending on what that line item might be, so whether it be like, they say generally a 7-year rule is for delinquent accounts that you might have. So in other words, that would be reflected on your credit score for a long period of time of 7 years, and then 10 years from an account being closed. So those areas, I mean, across the board, obviously that's a longer period of time that it can stay on your record, but it's also what shouldn't be discounted is your ability to improve your overall situation over time and show improvement. Because just like, a credit score is a living item. You can look one day to the next and your credit score can be different. It can make big swings and it can make small swings each and every day. But being able to have, showing improvement over time and doing the right things will always put you in a better position. So, when we do say that from 7 to 10 years, that information can be on your record, I wouldn't let that be something to really concern you all that much, because, the biggest thing to think about is those opportunities to improve your credit. And as we go through, having that new look each and every time your creditor looks at your overall accounts, that you're improving upon that. That's what's the most important. And to sort of go off of that as well, Dana, negative information that is on your account and improving on your overall situation, it's important to know what percentages of items might affect your overall score, and that also is a whole nother set, right? Because we would say there's FICO scores, there's a number of different scores that are out there and different people that report them, and each one has kind of a different type of calculation. Largely, we'll see FICO scores being a big one that people will look at and looking at somebody's individual credit. So 10% of so this is going to be just referring to FICO scores because again, that's kind of the top of the pile there. 10% of your overall credit score is calculated from your credit mixture. What type of credit you're taking on, what type of debt that you have, whether it be overall, mixture of student debt, you might have some loans through your business, you might have even individual credit cards, a diverse set, understanding that you're still making progress on paying that off is what they're looking for there. 30% is the accounts that you currently own. 35% is your payment history, which is the highest thing that you can really do to improve your overall credit score is to make sure that your payment history is squeaky clean. So I'd say the biggest takeaway from your credit score is to just make sure that you're consistently month over month making those payments, and auto pay is a huge boon to that. So I always recommend going that route. 10% is going to be new credit that you have and how recently that you've opened that new credit. And then 15% is going to be your credit history, not your payment history, but your credit history. So so just with that there, that's pretty much just talking about credit, important conversations surrounding debt, how to pay it off quicker, anything there. Any questions before we move on to kind of how you can leverage your own life insurance for your business and talking about collateralization? All right, great. So lastly, big thing, and on the topic of debt, is going to be, how we as business owners can better get the funding that we need to do what we need to do and to grow our business and to continue on that positive, trajectory. And a big part of that is getting loans, whether it be you want to expand, you want to even just get a storefront to begin with. Maybe you even just have actual things that you'd like to purchase equipment-wise for your business. Regardless of what you end up going through, and this is just going to be on pure debt consolidation, and we'll go to other other opportunities that you can use life insurance for in just a minute. But we're talking about you're going to have to get a loan, and in order to get that loan, it's really going to come down to at the end of the time, it's the risk on the lender. And the more that we can mitigate that risk across the board for both yourself and the lender, and maybe even your family or business partners, the more off, or the better off we're all going to be as we kind of continue in growing our business and whatnot. So basically, to talk about collateralization, you got to talk about the types of life insurance. And people don't always know that there are different types. There's a term policy that lasts for, just like the title says, a term period of time, 10, 15, 20 years. Some insurance companies go up to 30 years. And then there's also a permanent policy, which, as long as you abide by the rules of any contract that you you take part of, that it will continue for, into perpetuity until you pass away. At which point, that death benefit will pay out to individuals. So basically, the biggest thing that we have to look at in determining what would be the best for an individual, and specifically for a loan collateralization, if you're going out there to get a business loan, pretty much nowadays, most banks really want to have something in place to know that in the case that you pass away or you default on your loan, depending on what that loan might be, that they're taken care of. And so they'll probably require you, and if you maybe even experienced this already, to have a life insurance policy in place. Now, what type of policy that might be, term is great for, you have a period of time that needs to be covered. Maybe you have a 15-year mortgage for whatever it is that you might be doing, a 15-year loan of some sort, point to point, that needs to be covered for that period of time. In the case you pass away, you aren't able to pay that loan back. What you would do is you'd probably do a term policy for that type of collateralization. You would, at that point, name the assignee, which in this case would be your lender. They would be the assignee of your policy. Then you would name beneficiaries of your policy. Beneficiaries would be your spouse, your business partner, anybody else that you would want to, have money in the case that you pass away, in excess of the amount of loan debt that you have left over plus interest. So in this case, a assignee always supersedes the beneficiary. So let's say you have a $500,000 loan, $100,000 loan, whatever it might be. They need to have a term policy in place. As you pay that down over time, your assignee or your lender has less access to the death benefit in the case you pass away. The excess then would go to your beneficiaries. Now, pivoting over to a permanent life insurance policy, there's a bunch of different types of them, and most any individual out there in the business can explain those differences. All of it comes down to really how the money is invested in that life insurance policy, and whether or not you guys are familiar. You heard me right. In a permanent policy, you actually can use it as an investment vehicle, similar to an IRA you might have, a 401k through work. Anything else, all of those things are investment vehicles. In a permanent life insurance policy, which if we're using in this case, is going to be for actually the money that you save inside of it, is going to be for covering the specific amount of money in the case that you default on your loan for the lender to collect. So as you pay for your policy, you're paying for you to be in the case that you pass away, your death benefit. So let's say it's a $500,000 permanent policy and you pass away, the assignee takes their cut, the beneficiaries get the rest, but you're paying for that death benefit in the case of both a term policy and a permanent policy. Now, in this case of a permanent policy, you're going to pay a little bit more per month. So the additional amount that you're paying is for the living benefit of the life insurance. And that is that money that's saved and invested in the market. So let's say that you're a lender out there and they want you to have a permanent policy for a loan because you might have a shaky credit history and they want to make sure that in the case you pass away or you default on the loan, they have something to cover their end of things in both cases. Now, one would be the death benefit. You pass away just like a term policy, the assignee gets their cut. And two would be the living benefit, which is, let's say you default and you've already put money into that account and it's grown and you have an additional $5,000, $10,000, $15,000 that's saved and invested in that account. The assignee can take that cash value out of the policy to cover a part of that overall risk on their part. And it's important to note that if you ever go through this process, that an assignee and a beneficiary are two different things. You want to make sure you don't name your beneficiary as your lender. Now, the reason for that is if you do name your lender as your beneficiary, the lender is going to have access to pretty much all or most, depending on how much you allocate toward them as a beneficiary. It has to be 100%. They're going to have access to pretty much all of it no matter what. And that's what we don't want to have happen. We want it to be, as you pay down your loan, the assignee can take, or the lender can take less and less money so that more can go to your family in the case you pass away. And we would also hope too that when we go about doing a collateralization and talking about existing policies that you might have, that you're not having one policy be a one trick or rather a multi-trick pony. It can't do everything for you. If you have a policy to cover your family in the case you pass away, cover your business partner in the case you pass away so that they can go and search for a new business partner or new talent to cover that loss, maybe your kids' education and a collateralization, and suddenly you run out of money, and also you're putting all your eggs really in one basket from a risk management standpoint. So for that purpose, oftentimes banks will always ask you to either open a new policy, or they might have stipulations on what current policies you have and how those can be collateralized. So that conversation is one to be had with your financial professional, whomever you might work with, and really the bank and the lender as well as part of that conversation. And oftentimes, whomever it is that you work with would be more than happy to sit down with you in a meeting with the bank to make sure that everything's set up in the way that they would like it to be, because it really is a case-by-case basis.
Mm-hmm. Yep. And I know we're talking about a life insurance in regards to the collateral assignment and how it could be leveraged for loans, but also another resource that life insurance is used, and I know Colin kind of touched on this a little bit, is what we would call buy-sell agreements, or agreements that you have within your partnership that if you did go into business with something and anything happened to one of the business owners, that you wouldn't be responsible to, your life insurance would basically cover that person being removed and not having someone like their spouse coming into the business. So it's always good to kind of understand how life insurance can be used throughout your business plan while you're still working, or any unfortunate thing were to happen from a partnership standpoint. And I also like to note that there are different partnership points for people if you're in business with family versus people that there's no family relationship with. So it's good to always have those line items reviewed.
So I, like both of you, Sabrina and Colin, I could do this all day. I love talking about this. I immerse myself in these conversations, but I find that most people that approach me for these conversations, they don't, right? So with that said, can you just talk a little bit about the loan collateralization, or describe it if you would, and then let's say I'm a person who, and I know you talked about this slightly, Colin, if I don't have life insurance, how do I get started?
Good thing. So go ahead if you want, Sabrina. Or...
Yeah, no worries. I think the most important thing when it comes to getting yourself reviewed to see if you're qualified for life insurance, which just comes down to your health, is having a conversation with someone like myself or Colin, or even something as simple as if you're at a bank. A lot of banks have that opportunity to share with you some of the opportunities that you have and leverage the benefits that you have at work. Some of those don't even require any sort of medical evaluation. So I think it's always important. Colin and I are used to helping people, even though for whatever reason we can't, work with them, because we really do have the benefit of walking people through different steps that we're not always connected with, but it helps guide them in the right direction. So having the conversation to see if you would qualify, but also knowing that if you have a spouse that is a little bit healthier than you, that's also something that you can use to leverage, that's unique to business owners, and not the common public, or the general public wouldn't have that same benefit. So I hope that answers your question.
That's perfect. Thank you so much.
And in addition to that as well, a big thing that a misconception is that so across the board, you have to go through underwriting. So that underwriting is financial underwriting to make sure you can pay for the policy, because to collateralize a loan, to make sure that the bank's protected and that your family's protected and so forth, ahead of time, you got to make sure that you're paying those premiums or the dollars that, actually fund the policy for whatever the purpose might be, that you can pay those on an annual basis. So financial underwriting is one piece of that. Now, it is also important, by the way, underwriting happens completely behind the scenes. Pretty much you work with your financial professional, you work with the bank, whoever it is that you're working with. And it kind of it seems like you might not hear anything for 2, 3, 4 days, and then they'll come back and say, you've been offered this offer, maybe it would be a preferred offer, a standard offer, or a table offer. And there's a number of different ways you can break that down. But so really a lot of this doesn't have to do with anything that you have to do specifically. It's kind of what we do behind the scenes. So the second part of that is your health underwriting, just like Sabrina was talking about, where they look at your health. It pays if you don't see a prime care provider at least once a year. I would highly recommend that you would find somebody that you really like, that you can see as often as you really need to, at least once a year, because in the business of underwriting people, they have the whole lab tests where they might have you do blood work, maybe have a urine sample and do some brief medical history. Oftentimes, if you have an existing healthcare relationship and you see your primary care provider at least once a year, they'll actually allow you to completely waive that. And just by talking with your prime care provider, the notes that they have, and they can actually understand the type of individual that you are, your health history, and make a rating right off of that. And you don't need to go through all that extra work. So just ahead of time, that's good prep. But really, the crux of everything here is that if you go through the underwriting process, it's non-binding. So don't ever think that, if you go in and work with any financial professional, or you, as somebody at a life insurance company, that once you apply for something, you're totally locked in stone. And even if you pay that the first premiums, there's a grace period that you can experience where you can still get refunded for everything before you hit the post grace period, where then there might be a surrender charge, or maybe depending on the policy and depending how you structure that. But most important thing there is, don't be afraid of underwriting. It's a necessary part of the process, and it's non-binding. So as you go through it, what we'll often say is, let's at least apply and see what we get back. And then once we have your rating, we can determine the precise pricing, and then we can give you a number of different policy options. And then from there, you make the choice on if, how, and when you'd like to move forward. So it really empowers you more to go about it that way. And I guess lastly, it would be to make sure that if we're doing a collateral assignment, that first you come to us with your closing date, ahead of time if possible, or, by the way, we don't need to have one. If you want to have initial conversation saying, I'm thinking about doing this and I know I need a policy, I just want to get you, in the know ahead of time. That's important as well. Just kind of giving us a heads up. Then from there, we'll make a, kind of send it out for underwriting, see what comes back, make a recommendation. We sign a bunch of paperwork, naming your assignee, naming your beneficiaries. The process is going to be pretty much the same, uniform all the way through. Then once you sign the paperwork, you approve that policy. We then, after it's already enforced, go and do the collateral assignment with the bank or other lender. And then we would make sure we follow up at least once a year to make sure everything's going all right, and make changes as necessary.
The only other thing I will add is I think it's also very important to do what we call a life insurance needs analysis, and it kind of helps you understand how much life insurance you need and for what. And that also helps you navigate how much of your life insurance really needs to be on a permanent basis and how much needs to be more of a term, which is a bit more of an affordable option. And the reason why that is so important is because we don't want to make anyone life insurance poor. Colin and I are financial advisors, but we partner with Equitable. So we are going through the business developing stages. So we know the struggle in the beginning years of starting up a business and knowing that you need to make your dollars stretch, but you also need life insurance, you know, those sorts of things. So we want to make sure that there is a balance, and we're not encouraging you to do something that isn't affordable. We're just encouraging you to making sure that you look at your options and know what is, one, going to be affordable and covering your needs, but two, also something that's going to be advantageous because you hold those titles like business owners and things of that nature.
Excellent.
Mm-hmm. So I want to be mindful of everyone's time. I see the time is 12:56. How are we doing for time? And does anybody have any questions?
I don't see any questions.
Okay, excellent. I might have missed it. At some point, someone asked about having shared. Are we expected to share something? I kind of missed. Oh,
Yeah,
thank you.
the
Thank you,
template for
Eileen.
the client. The template for the client expense sheet, so the budget, budgeting and everything with the tax. Yeah. So
Okay.
as far as that goes, we can, I'm sure we'll connect with Dana right afterwards. We could email it over to you is probably the easiest way, especially now in COVID world. So we can get that to you guys. It'll allow you to see exactly what you're spending, what your effective tax rate will be, as well as kind of a pie chart breakdown where things might be going, what's unaccounted for. And then it allows you to see if of that money that's not accounted for, you know, present it to whomever it is that you might be working with. And then from there, they can make a determination where that money might best benefit you as a business owner, as an individual, and as somebody who's trying to kind of grow their financial future.
That would be great, because I think everybody on the Zoom here with us wanted a copy of that. So if you could send that over, that would be fantastic.
Perfect.
Sure thing.
And I don't see any other questions. Nope, yeah, I think we're good. So I do want to thank our expert guests for today. This was great information. It was very insightful. I want to thank everybody for joining us. I hope that everyone that was on with us today gained some insight on the financial fundamentals, as well as leveraging your credibility for a business loan. And again, I want to thank you all for joining. Thank you so much and have a great day.
Yes, likewise. We appreciate it. Bye for now.
Thank you.
Bye-bye. Thank you.